Hi, everyone. This is Dale Branda. I'm with Stewart Advisors, and welcome again to today's webinar. Our presenter today is going to be my colleague, Tim Obendorf. Tim is the founder of Stewart Advisors, and he's been working with families and individuals for more than 20 years. He's a veteran of a lot of questions about retirement planning and Social Security in particular, so he's a good one to take us through today's key questions. Just before we begin, I just thought you should know Stewart Advisors is a financial planning and investment firm, and our mission is to help families and small business owners realize their goals and make good financial decisions. We provide a range of services, and our goal is always to help clients develop a consistent, holistic financial plan. So with that, I will turn things over to Tim, and we'll get started.
Thank you, Dale. As we get started, I'd like to give you a roadmap for today's discussion. And unfortunately, Social Security rules can be very technical. So we're going to start with some of the details around options for claiming Social Security, how benefits are calculated, and then how earnings and taxes can impact your benefits. But I encourage you to stick with us through the technical discussion as the payoff comes when we review a case study where we show how a couple is able to increase their investable assets by almost 20% using some simple strategies. And then we'll end the review of with a review of the Social Security Trust Fund solvency, and then leave some time for questions. So let's get started. One question we get asked fairly frequently is, when should I claim Social Security? I wish there was one simple answer or rule of thumb that I could tell you, but the answer to that question is really complicated. We've listed here a number of the factors that have to be taken into consideration when choosing to claim Social Security. The first is a simple one: when will I retire? But that's not synonymous with when you claim Social Security. Second, how much is your benefit? Third, what are the tax implications? Fourth, when should I use other retirement funds? Fifth, which retirement funds should I tap first? Sixth, when should my spouse claim? And lastly, what is my life expectancy? So over the next few minutes, we're going to address some of these questions and how they impact your Social Security claiming decision. As Dale mentioned, we're a planning-focused financial advisory firm, and we really do believe that the best financial decisions are made in the context of a comprehensive financial plan. And as we noted on the prior slide, there are so many factors that impact financial decisions, like when to claim Social Security. And the best way we know to make the decisions line up with your values and your goals is to prepare a comprehensive financial plan. This doesn't mean that you prepare an 80-page document that gets stuffed in the bottom desk drawer, never to be seen again. When we talk about a plan, we mean a model of your financial future that can help you weigh the impact of choosing alternate options. So a little later, we're going to review a case study, and we'll show you how a plan can help you make good choices. On the bottom of this slide here, we have some key dates that drive many of your decisions. And as you progress through time, you're going to want to evaluate how you're tracking compared to your plan and make adjustments along the way. So think of your plan as a living model of your future. Now, to make informed decisions about your Social Security, you'll need to understand some of the basics about eligibility and how your benefit is calculated. Anyone who has worked and paid FICA for 40 quarters is eligible to receive a retirement benefit. In addition, spouses and ex-spouses and widows or widowers of an eligible recipient are also eligible for a benefit. The amount of your benefit is based on your earnings history. And as you may know, your earnings that are subject to Social Security tax are capped each year. So for 2021, the cap was $142,800, and that's up from $137,700 in 2020. Each year of earnings is adjusted for inflation, and then your 35 highest earning years are averaged together. This average earnings amount is what drives your benefit. And note that there's different earnings levels where the next dollar of earnings is worth less of a benefit. This calculation is a little too complicated to go through right here, but the end result is that you get a primary insurance amount, or the benefit that you'd receive at your full retirement age. And if you claim benefits before your full retirement age, the benefit gets reduced, but if you delay, your benefit will be increased. So on the right-hand side here, you can see a sample Social Security statement, which shows the monthly amount that this person could receive at various ages. Now, there's no need to learn all of these rules and remember all this, since the Social Security Administration provides an online portal where you can view your benefit. And if you haven't done so already, you should check your Social Security benefit and earnings history at the Social Security website. You'll be able to see your estimated benefit based on your earnings history, and make sure that the earnings history is correct so that your benefit calculation is correct. Also, by setting up your online account, it's a great way to prevent identity theft. Now, anyone who's eligible to receive Social Security benefits can claim their retirement benefit starting as early as age 62, or they can delay to as late as age 70. The most frequent choices for claiming are age 62, your full retirement age, or age 70. And historically, the full retirement age was set at age 65, but over time it's been increased to age 67 for anyone born in 1960 or later. As I mentioned before, there's a reduction in benefit for claiming early and an increase in benefit for claiming later than your full retirement age. This increase stops at age 70, so there's no benefit in delaying beyond that. In the table here, you can see the multiplier for various claiming ages. So this person's full retirement age is age 67, so at age 67, the benefit is 100%. If they claim before age 67, the benefit's reduced by 6 2/3% each year, with the smallest benefit being at age 62 at 70% of their full retirement age benefit. On the other hand, if they delay, for each year that they delay, the benefit goes up by 8% to a maximum at age 70 of 124% of their full retirement age benefit. This graph is an analysis we did for a client, and he wanted to know how long it would take if he waited until age 70 to start his Social Security to catch up to the amount of benefit that he would receive if he started at age 62. So it's a pretty simple graph. We just graphed the cumulative amount of benefits under each claiming age, and we adjusted it for inflation. So based on his Social Security statement, his benefit at age 62 would have been $2,085 per month. And at that rate, the client would receive about $500,000 in benefits by age 80 and $1 million in benefits by age 92. On the other hand, if he waited to age 70 to claim, he has no benefit up until age 70, $500,000 of cumulative benefits by age 80, and about $1.5 million in cumulative benefits by age 92. So it's fairly typical that the break even between different claiming dates is somewhere around age 79 or 80. And you may be thinking that that makes sense since average life expectancy is around 79, but be careful about making your decision based on the average life expectancy. The table on the right shows that you're likely to live beyond this break-even date, and there's a high likelihood that either you or your spouse will live past age 90. The top table shows the life expectancy of a typical 65-year-old. And what's interesting is that for a married couple at age 65, on average, one spouse will live to at least age 92. And the bottom table there shows the likelihood of a 65-year-old living to age 90. So men have a 32% chance of living to 90. Women have a 44% chance, but the odds of at least one spouse living to 90 is 62%. So pretty high likelihood that one of you will live to 90. And if you're curious about your own life expectancy, we've added a little resource here, livingto100.com. And if you go there, you can fill out a short questionnaire, and it'll actually calculate a rough estimate of your longevity. And along with your life expectancy, it'll give you a couple suggestions about how to increase your life expectancy. So that's a lot of information here, but just remember that the longer that you expect to live, the more advantageous it is to delay claiming your Social Security. Because the likelihood of one spouse living to 90 is so high, it's really important to understand the spousal benefits available from Social Security. When you apply for Social Security, the Social Security Administration will calculate whether your primary benefit that's based on your earnings or 50% of your spouse's benefit is greater, and they'll automatically give you the higher benefit. So note that the spousal benefit is based on your spouse's full retirement age benefit and does not become available until your spouse actually begins their own benefit. There are two situations we typically see with spouses. So one is where both spouses have a fairly similar benefit. So for example, let's say a husband and wife each have a $1,000 monthly benefit. For each spouse, their primary benefit of $1,000 is greater than their spousal benefit of $500. So each spouse will receive their $1,000 primary benefit. The second situation is where one spouse has a much greater earning history than the other one. Let's say one spouse's benefit is $2,000 a month, and the second spouse's benefit is $500 per month. So the higher earning spouse will receive their benefit of $2,000. However, the lower earning spouse will receive a $1,000 spousal benefit because it's greater than their $500 primary benefit that they'd earn on their own, that they'd receive on their own earnings history. And this is an oversimplification, as each spouse could elect to receive their benefits at a different time, which has other repercussions. But just know that the spousal benefit is something to consider in your start date of when you claim Social Security. Also, just note that there's a survivor's benefit. It's a small benefit, but it's available to widows and widowers, and that's based on when the deceased spouse began their benefit. So this is one more variable that impacts your claiming decision. Because the total benefits received are impacted from both the timing of claiming your benefit and the timing of your spouse claiming the benefit, we encourage you to work with an advisor to understand the projected benefits of various spousal claiming strategies, because this gets really complicated when you add two people's claiming strategies together. So we're going to switch gears a little bit and talk about how your earnings can impact your Social Security benefit. And there's two ways that this can happen. First, if you claim a benefit before your full retirement age, your actual benefit can be reduced based on other earned income. And secondly, if your taxable income is above certain thresholds, your Social Security benefit may be taxed. So let's take a look at what happens to someone that claims their benefit before their full retirement age and continues receiving some other earned income. So for every $2 earned above $18,960, the Social Security benefit will be reduced by $1. This reduction is not lost, however, as it gets added back to your earnings record and increases your future Social Security benefits. You'll have to report your earnings to the Social Security Administration each year, and they'll hold back on the benefit until the earnings reduction amount is met. So for instance, if 50% of your earnings is reduced, they won't send you a benefit until halfway through the year, and then they'll send you your full monthly benefit. And note that there's no benefit reduction from earnings after your full retirement age, and your earnings have no impact on your spouse's benefit. So the table on the right here shows you a few different scenarios of how earnings impact somebody's benefit. So just taking the first three rows there, this is somebody whose monthly benefit is $700, and if they earn less than $18,960, they get a full benefit of $8,400 for the year. Now, if their income was $20,000, they'd reduce their benefit by $1 for every dollar that their income is over that $18,960. So at the end of the year, they'd only receive $7,880. So just a couple different scenarios to give you an idea of how the income impacts Social Security benefits. Now, second impact that outside earnings may have is that you could end up owing taxes on your Social Security benefit if your earnings are above certain thresholds. So for a married couple, if your combined income is between $32,000 and $44,000, you'll have to pay tax on 50% of your Social Security benefit. For income above $44,000, up to 85% of your benefit will be taxable. That doesn't mean an 85% tax rate, it's just that 85% of the benefit gets included in taxable income. And the measure for these income thresholds is based on your adjusted gross income plus non-taxable interest, so that would be interest on municipal bonds, plus half of your Social Security benefit. And just know that these thresholds are not indexed for inflation. So over time, we're seeing more and more income, more and more Social Security income get subject to taxation. And note that some states do tax Social Security income. However, in Illinois, this is one of 37 states that does not tax your benefits. So it's one of the few kind of income tax pluses that we have here in Illinois. So we started this webinar with a list of things to consider when claiming Social Security, and noted it's really complicated and it may be different for each family's circumstances. So that's why we recommend integrating your claiming decision into a comprehensive financial plan. By doing that, you can identify sources of funding and determine which sources to tap when, such as a taxable versus a tax-deferred investment account. And you'll also be able to identify years where your tax rate may be low and take advantage of strategies such as a Roth conversion. You'll also want to run scenarios with different spousal claiming dates, such as one spouse claiming at age 62 and the other waiting to age 70, because it's not always clear which strategy is going to be the most successful until you run the numbers. To help illustrate how planning can help maximize your benefit, we're going to take a look at a real-life example. John and Karen are age 61, and they plan to retire at age 65. They have $250,000 in taxable investments, $500,000 in a 401k, $250,000 in an IRA, and they own a home worth $500,000. They don't have any debt, so we don't have to worry about that. And their current combined income is $200,000, and they spend about $110,000 per year, not including tax. Now, they've heard that you should delay claiming Social Security as long as possible, and they plan to claim at age 70. They also have heard that you should keep funds invested in a tax-deferred account as long as possible. So they plan to fund the years before receiving Social Security with funds from their taxable brokerage account. Based on their current plan, we created this cash flow projection. And I know there's a lot of numbers here, but let me just orient you to what we're showing. The first column shows their salary income until retirement, and then we also have their Social Security benefits starting at age 70. The second column shows the amount that they have to take from their 401k and IRAs to cover required minimum distributions. Their expenses in the middle column include both their living expenses as well as taxes. And based on the income and expenses, you can see the net cash flow and their portfolio assets in the second and third columns from the right. Finally, the last column shows you their tax rate, which ranges from 1.6% on the low end up to almost 24%. And these are average tax rates, so it's not their marginal tax rate. Their marginal tax rates would be much higher. And then we took this plan and we ran it through a Monte Carlo simulation. So it's in a sense, it's just a method where we run 1,000 different scenarios with different investment returns, and we see how many of those 1,000 scenarios they have enough money to last their lifetime. In their case, right now, before any changes to their plan, their success rate is 86%. So 86% of the scenarios we ran, they had enough money to last their lifetime. Now, based on the variation of their tax rate over different years, we identified several opportunities to improve their retirement income. First, we recommend that John and Karen make a series of Roth conversions each year from their retirement date until they have to start taking required minimum distributions at age 72. Second, John and Karen should fund some of their living expenses with funds from their IRA. So don't leave funds in your IRA as long as possible. Let's start tapping them during years where they have low income tax rates. And then third, we recommend that they begin taking Social Security at age 67 instead of age 70. And these simple strategies help smooth out their taxable income and result in lower taxes over their lifetime and higher investable assets. In fact, we project they'll increase their portfolio assets by 500,000 over their current plan. Not only will they have more assets, but they'll move about 1.7 million into a tax-free Roth account. So that will benefit John and Karen in the event that they ever need to tap that Roth account, but it'll also benefit their heirs as they'll inherit tax-free investments from this Roth. And these changes not only increase their portfolio assets, but it improves their Monte Carlo success rate to 87%. And you may be thinking that's not a very big difference, but if you understand that the cases that fail tend to be low investment returns, moving from 14% of the time failing to only 13% in the lowest investment return environments is actually a pretty good outcome. So here you can see a picture of how the above strategies impact John and Karen's investment assets over time. On the left-hand side is their original plan, which results in total investable assets of about 2.6 million at age 95. In this scenario, almost all of their portfolio ends up being in qualified accounts, which will be subject to tax when they're withdrawn. So if John and Karen have to withdraw them, they have to pay tax. If their heirs inherit these accounts, they'll have to pay tax on the tax-deferred accounts. But on the right-hand side, you can see that their investment assets are a little bit larger with the Roth conversion and IRA withdrawals and earlier Social Security claiming. So the total assets grow to nearly 3.1 million, with about half of those assets now in a tax-free Roth. So that amber or yellow color is the Roth account, and you can see how by age 95, a significant amount of their net worth now is tax-free. Here's a summary of some of the strategies that we explore when integrating Social Security claiming with a client's financial plan. And this is something that we do with all of our clients. And it's not always obvious which strategies are going to be beneficial. So we recommend building a financial projection and running multiple scenarios to test which strategies will actually work in your situation. Now, the claiming decision is an important decision, but I want to also highlight some other miscellaneous things that you have to think about with Social Security. And these things often get forgotten in the Social Security discussion. So the first is, don't forget to apply for Medicare at age 65. So if you've already claimed Social Security before age 65, this is automatic. But if you delay your Social Security benefit, you're going to have to proactively apply for your Medicare benefit. And just be aware that you have a 7-month window to apply, and that 7 months is 3 months before your 65th birthday, the month of your birthday, and then 3 months after your birthday. And if you miss that window, there's a permanent penalty of a higher rate that you have to pay on Medicare. Secondly, the cost of living adjustments for your Social Security benefit mean that your benefit will grow over time. And since future inflation is unknown, this indexing helps manage a huge risk that retirees have. And this is a bigger risk with all the news right now about inflation, whether it's going to spike up significantly and stay up, or whether it's just a temporary increase. But Social Security is tied, your benefit is tied to the inflation numbers each year. And then thirdly, your personal health and family history need to be taken into consideration when you decide when to claim. So if you have an illness that may shorten your life expectancy, by all means, you want to start your benefit as early as you can. On the other hand, if you're healthy and you have family members that have lived to 100 or beyond, you need to make sure that you cover the financial risk of living that long, and that probably means delaying your Social Security benefit. And then fourth, survivor benefits are impacted by your claiming decision. So don't just think about your life expectancy. You have to also consider your survivor's life expectancy. And finally, if you realize you've made a bad decision, there are some things that you can do to fix this. So you can repay and undo the claiming within 12 months, or worst case, you can suspend your benefit and accrue additional benefits up until age 70. One question you may be thinking is whether there will be any money left in the Social Security Trust Fund to pay your benefit. And there's a lot of misinformation swirling about, so we checked with the source. We went to the Social Security Trust Fund report to get the facts. This is a report that's issued each year, and the latest report estimates that if no changes are made to the program, the trust fund will be depleted in 2034. But that doesn't mean that benefits will suddenly stop. So at that point, there's estimated to be enough payroll tax coming in each month to cover about 76% of projected retirement benefits. And that's the worst case, but we expect that there'll be political pressure mounting to address this issue. And the fix could come in a couple forms. One is that they could adjust the claiming age. So if you push out the claiming age, the trust fund will last longer. The second is that they could increase payroll taxes relative to the benefit. But even if the program changes are not made, Congress could and probably would authorize payment of benefits out of other government funds. So because of all this, we currently view that a reduction in benefits is pretty unlikely. And for our clients, we continue to include the full Social Security benefit in their retirement income plan. So that brings us to the conclusion of the presentation. I'm going to turn it back to Dale, and we'll have some time here for Q&A. Dale?
Thanks, Tim. We do have a couple questions that have come in. We'll get to those in just a second. We'll just remind folks who are listening, if you have a question, you can submit it using the Q&A button on the screen. We're going to start answering them in a second here. And while you're thinking about that, wanted to show you this screen. These are some of the resources that Tim cited in his presentation, and a few other things that we've put together that we think are good resources as you think about Social Security and retirement planning. Also, just note on the right-hand side of the screen, our website at stewardadvisors.com has a retirement center where you can find a number of different white papers, some other webinars that we've done in the past on related topics, and a whole bunch of good information on the topic of retirement planning. So I would definitely check that out if you can. So with that, let's turn to a couple of questions. We did have one that came in regarding, and the question is, if you use a regular brokerage account to fund expenses between retirement and tapping Social Security funds, are you still going to pay taxes after selling the assets that you need to finance the expenses?
Yeah, that's a really good question. And I think that question highlights the need to actually do some planning and look for opportunities for how to manage the taxes, whether it's taxes incurred from selling appreciated assets or taxes from withdrawing from IRA accounts or even Social Security income. And the one thing I'll say here is that we typically see when we do planning for retirees, we typically see that income levels drop after retirement and stay pretty low for a number of years until Social Security benefits and required minimum distributions start. So there's often a window where retirees are in a pretty low tax bracket. And particularly when it comes to capital gains taxes, a lot of people don't realize that for a married couple, there's a bracket up to $80,000 of income where capital gains tax is actually 0%. So by managing the timing of when you sell those assets, if you do it over a number of years, you may be able to do it at a very low or even zero tax rate. But good question, and that's really where planning and doing some tax projections can help maximize your retirement income.
Another question that came in has to do with Roth IRAs, and the question is, do you think the government will change the rules or eliminate Roth IRAs entirely?
Yeah, so that's a question we get fairly frequently, and what I will say to that is that Roth IRAs have been around for quite a while. They were established in 1997. The tax-free nature hasn't changed since then, and Roths were kind of set up. There's kind of a bargain made when the Roth Roth concept was established by Congress, and the bargain was you don't get a tax benefit today when you put money into the Roth, but those funds are tax-free in the future. So it would be, I would say it would be a political danger zone for Congress to go back on that bargain. Now, of course, Congress can do all kinds of things to change taxes, and nothing in the tax code is permanent. So it's something to keep in mind, but we view it as pretty unlikely, and it would result in a pretty big backlash politically if that tax-free nature of Roths was taken away.
And then our final question goes back to your discussion of working and claiming Social Security. The question is it worth it to work and claim Social Security, considering all the issues around benefit reductions and taxation, et cetera?
Yeah, I guess the big picture about working in Social Security is that if you want to work and enjoy work and want to have extra income, you will always be better off financially having that extra income. Now, it may, in total, it may not be dollar for dollar an increase in your income. So if you earn $100 from outside work, it may only benefit you $50 after that Social Security reduction is taken into account, but it's always better. Also note that if your benefit is reduced, as I mentioned, that gets added back into your benefit calculation after your full retirement age. And so, it may not be quite 100% benefit for working, but it's always better. And especially for folks that enjoy working or find some meaning and purpose in their work, by all means, don't let the reduction and the taxation of Social Security benefits keep you from doing work and doing something that you enjoy.
Thanks, Tim. That is about all our time for today. We hope you've enjoyed the webinar, and we want to thank you for attending. Before we let you go, I would just remind you all, we know this is complicated stuff, and we know that in many cases it takes some scenario planning and some individual planning to maximize your Social Security benefits. So if you have any questions or are interested in a one-on-one consultation, feel free to reach out to Tim or any of us at Stewart Advisors. Our names and numbers are there on the screen. So again, thank you for attending. We will follow up in a couple of days with a copy of the slides, so we'll have all of the resource material that Tim cited. And with that, we thank you again for attending.
Thanks, everybody. Bye-bye.